If you were starting out again today, what would you do to replicate your success?
I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums and there's more chance that something is overlooked in that arena. But that's the only way to do it. I mean, you have to buy businesses or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about. And you can't expect anybody else to do it for you. People will not tell you about wonderful little investments. It's not the way the investment business is set up. You know, you've got to learn what you know and what you don't know, and within the arena of what you know, you have to pursue it very vigorously and act on it when you find it. And you can't look around for people to agree with you. You can't look around for people to even know what you're talking about. You have to think for yourself. And if you do, you'll find things.
Have you ever looked back and thought, I should have seen that opportunity? In 2025, the fear of missing out is everywhere. But the real challenge is cutting through the hype to find investments that truly matter. In this video, I'll show you how to cut through the chaos and focus on what really matters. Using Buffett's proven methods, I'll show you strategies to thrive in today's unpredictable market. Warren Buffett's annual letter to shareholders in 2025 started with a heartfelt tribute to his longtime partner Charlie Munger, who passed away recently. Buffett acknowledged Munger's pivotal role in shaping Berkshire Hathaway, calling him the architect of its success. It was a 60-year friendship built on mutual respect, shared values, and a relentless pursuit of quality investments. Buffett highlighted one of Munger's biggest contributions, shifting their focus from chasing undervalued stocks with limited growth potential, the cigar butt approach, to seeking companies with durable competitive advantages. This philosophy laid the foundation for Berkshire's immense growth. But the letter wasn't just about reflection. Buffett emphasized key lessons for navigating today's markets, which he described as increasingly speculative and emotionally driven. He pointed out that patience, discipline, and focusing on fundamentals have never been more critical, especially in a market that he compares to a casino operating in every household. The financial world in 2025 feels like walking through a storm. You can't always see what's ahead, and it's easy to feel overwhelmed. Inflation, while not as crushing as it was a few years ago, it still looms over us. Prices remain stubbornly high, making everyday life more expensive and causing ripple effects across industries like real estate and consumer goods. High interest rates, set by central banks to keep inflation in check, are another hurdle. They've made borrowing more expensive, slowing down businesses that depend on credit to grow. Then there's the wild roller coaster of the stock market. Thanks to the surge in retail trading, the market has taken on a casino-like vibe. It's noisy, emotional, and unpredictable, with daily price swings that feel less like investing and more like gambling. For anyone trying to stay calm, this environment makes it hard to focus on what really matters. Technology is another double-edged sword. Breakthroughs in AIs and machine learning are changing everything, from how we work to how companies operate. But with these advancements come a lot of unknowns. Some companies are adapting and thriving, while others are struggling to keep up. The pace is changing so fast that it's hard to tell which trends will last and which will fade into the background. On top of this, the world feels more divided than ever. Geopolitical tensions and supply chain disruptions have made doing business globally a lot more complicated. Companies are spending more to shift production closer to home. Many are dealing with higher costs and delays. It's a tough environment to navigate, especially when global trade isn't as smooth or reliable as it used to be. Right now, the landscape feels chaotic, full of challenges. For anyone trying to make sense of it all, it's kind of like being handled a puzzle with missing pieces. The stakes are high and the pressure is real. So, what should your strategy be for 2025?
If you were investing a small sum today, which approach would you use?
I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the cash they would produce in the future. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's industrial manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. I would find one or two that I could put $10,000 into or $15,000 into that were ridiculously cheap. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something that promise very significant sums.
Warren Buffett's investment strategy is a blueprint of logic and discipline, built on principles that have stood the test of time. But in 2025, as markets evolve with unprecedented speed, his approach gains even more significance, offering not just a path to profits, but a shield against uncertainty. The economic backdrop underscores the importance of Buffett's strategies. Between 2020 and 2025, the U.S. inflation rate reached unprecedented highs, peaking at over 8% before gradually declining. Meanwhile, the Federal Reserve's response was aggressive, raising interest rates from near zero in 2020 to over 5% in 2023, where things have remained steady. These dramatic shifts are reflected in the market's volatile performance, emphasizing the need for Buffett's long-term perspective. At the heart of Warren Buffett's investment philosophy is the concept of value investing. It's a simple yet powerful idea. Look for businesses that are worth more than what they're selling for. Imagine finding a company valued at $100, but trading for just $70. That's the sweet spot Buffett looks for. He believes in paying a fair price for a great business rather than overpaying for something mediocre. In today's turbulent markets, where wild price swings are the norm, this approach is more relevant than ever. These fluctuations often create opportunities for savvy investors to scoop up undervalued gems. However, not all opportunities fit Buffett's massive portfolio. With Berkshire Hathaway's market cap nearing $1 trillion, Buffett has to focus on deals big enough to make a noticeable impact, usually involving companies with market caps over $100 billion. For individual investors, though, this limitation opens a world of possibilities. Smaller, high-potential companies often fly under the radar of giant firms like Berkshire, creating a chance for significant returns. For example, investing $10,000 in a business growing at 15% annually can double your money in less than 5 years, thanks to the magic of compounding. But more on that later. A cornerstone of Buffett's strategy is finding companies with a moat, a durable competitive advantage that shields them from competitors and ensures steady profitability. Think about the difference between Apple and HP. Apple's ecosystem of products and services creates high switching costs for customers, making it harder for competitors to chip away at its market share. That's why Apple has delivered an average annual return of 27.96% over 5 years. Compare that to HP, whose commoditized market and low switching costs make it more vulnerable to competition. As a result, HP's average return is just 13.69%. Buffett's focus in 2025 remains clear. Invest in companies where the moat isn't just strong, but expanding, like Apple's unmatched innovation and brand dominance, rather than those struggling to defend their turf. Buffett also emphasizes the dangers of speculative investments. Sectors like cryptocurrency and overvalued AI startups are perfect examples of what he avoids. Why? Because these companies often come with inflated valuations and no real profits to back them up. Buffett's reasoning is straightforward. If you buy into the hype at 50 times earnings, even a small shift in market sentiment can send the stock price plummeting, halving your investment in no time. Instead, he focuses on businesses with solid earnings and realistic valuations. A simple example, buying a company with a price-to-earnings ratio of 15 and consistent annual earnings growth of 10% positions you for steady, reliable gains. Patience is another cornerstone of Buffett's strategy, and in 2025, it's more important than ever. He often describes market downturns as treasure troves for disciplined investors. Think about it. A strong company's stock drops 30% because the market panics. For most people, that's a warning sign. For Buffett, it's a golden opportunity. His famous mantra, be fearful when others are greedy and greedy when others are fearful, isn't just clever, it's been proven time and time again. Just look at 2008, when Berkshire Hathaway poured money into undervalued assets during the financial crisis and came out with billions as the market recovered. As we move through 2025, the global economy is rapidly evolving, offering a mix of challenges and opportunities for investors. While Warren Buffett firmly believes in sticking to time-tested principles, he also acknowledges the need to pay attention to emerging trends. One such trend that's impossible to ignore is the explosive growth of artificial intelligence. The AI market is booming, projected to grow over 36% annually, with healthcare, finance, and manufacturing at the forefront. But here's where Buffett's timeless wisdom comes into play. He warns against speculative investments in AI companies. Many businesses in this space are hyped based on potential rather than proven profitability. Buffett's advice? Avoid overpaying for story stocks, those whose valuations are inflated by excitement but lack tangible results. Instead, focus on companies that have clear paths to profitability and a demonstrated ability to use AI effectively to enhance the bottom line. For investors wary of AI speculation, cross-border opportunities may provide an alternative. Expanding into international markets, particularly in regions like Asia, can offer access to companies that are innovating with AI without the overhyped valuations seen in U.S. markets. The graph shows the projected exponential growth of the global AI market, surging from $65.48 billion in 2020 to an estimated $1.58 trillion by 2030. This represents a staggering compound annual growth rate of 38%. Driven by AI's transformative impact across industries such as the healthcare, finance, and manufacturing. The data highlights AI's potential as a critical driver of economic value over the next decade, with revenue nearly doubling every few years. Another area with massive potential is green energy. As governments worldwide push for net zero carbon emissions, investments in renewable energy are accelerating. Solar, wind, and battery technologies are at the forefront, with the renewable energy market expected to surpass $2 trillion by 2030. Companies like Tesla, known for their leadership in battery technology, are innovating rapidly. However, Buffett's approach would focus on established players with consistent cash flows, firms that balance innovation with financial stability. International markets, particularly in Asia, are emerging as hotspots for growth. Countries like India, which boasts a GDP growth rate of over 8%, present opportunities in technology, infrastructure, and consumer goods. While investing abroad comes with currency and geopolitical risks, Buffett has historically encouraged looking for companies with robust fundamentals, regardless of their geography. Meanwhile, income-generating investments such as REITs or real estate investment trusts and utilities are gaining attention. With higher interest rates, these sectors offer reliable yields and are particularly attractive to investors seeking stability. For instance, an REIT with a 6% yield and steady occupancy rates can provide both income and capital appreciation over time. Buffett's wisdom for emerging opportunities is simple but profound. Invest in what you understand. Whether it's AI, green energy, or international markets, the key is to thoroughly research the sector and the companies within it. Warren Buffett often says the smartest investment you can make is buying a great business and holding on to it for as long as the company keeps performing. This philosophy revolves around the power of compounders, companies that generate steady returns and reinvest profits to grow even more. Take Coca-Cola, one of Buffett's most famous investments. Back in the late 1980s, Berkshire Hathaway purchased Coca-Cola shares for about $1.3 billion. It was already a global leader at the time, but what attracted Buffett wasn't just the brand. It was the company's predictable growing cash flow. Fast forward to today, and Coca-Cola's annual dividend payments alone bring in over $704 million for Berkshire Hathaway. That means Berkshire is now earning more than half of its initial investment every single year, just from dividends. This is the magic of compounding. Holding on to a strong performing asset for decades turns a good investment into a phenomenal one. Another shining example is American Express, a stock Buffett has held since the 1990s. But compounders aren't just about dividends, they're about the power of reinvestment. Companies like Apple are the perfect example. Apple doesn't just return money to shareholders through buybacks and dividends. It reinvests its earnings into innovation, new product development, and expanding its ecosystem. The result? Exponential growth in shareholder value. Apple's ability to consistently reinvest profits while maintaining predictable earnings and strong leadership has made it a textbook example of a modern compounder. Buffett's advice for spotting compounders is as clear as it gets. Look for companies with a durable competitive advantage, a proven history of performance, and products or services that people rely on no matter the economic climate. Companies like Coca-Cola, Apple, and American Express aren't just profitable, they're embedded in daily life. Once you've found a business like that, Buffett says the hardest thing to do is almost the most important. Nothing. Let the time and compounding work its magic. It's a simple truth that often gets overlooked in today's fast-paced market. Sometimes, the best investment decision you can make is to trust the process, stay patient, and watch your money grow over the years. Want to know what Warren Buffett's advice is if the S&P returns 3% over the next 10 years? Click the video on the screen to find out.